Why are there not more people talking about these critical investment mistakes? It's surprising how often these mistakes are overlooked, even by seasoned investors. Let's dive in and save your financial future. By understanding and avoiding these pitfalls, you can significantly improve your investment outcomes. Investing can be intimidating, but avoiding these 3 common mistakes can set you up for success. First up, delaying investment. Many people think they need a large sum to start investing, but that's not true. The power of compound interest works best over time. The earlier you start, the more time your money has to grow. This is one of the most powerful concepts in investing. Even small contributions can grow significantly if you start early. For example, investing $100 a month at an 8% annual return can grow to over $150,000 in 30 years. Imagine what could happen if you started even earlier or invested more. Waiting only means missing out on potential returns. Procrastination can cost you thousands in the long run. The longer you wait, the harder it becomes to catch up. Next, don't let emotions drive your decisions. The stock market can be volatile, and it's easy to get caught up in the highs and lows. Emotional investing often leads to poor decisions. Impulsive buying and selling based on market fluctuations can lead to poor timing. For instance, selling in a panic during a market dip can lock in losses. This is a common mistake that can be avoided with a clear strategy. Instead, stick to a disciplined buy and hold strategy. This means holding on to investments for the long term, regardless of short-term market movements. This approach has been proven to yield better results over time. It's less exciting, but it usually yields better long-term results. Historically, the stock market has trended upwards over time. Patience and discipline are key. Lastly, watch out for high investment fees. These fees can significantly reduce your returns over time. Many investors overlook this, but it can have a huge impact. Fees can really eat into your returns. For example, a 2% fee on a $100,000 investment can cost you $2,000 a year. Over time, this adds up and can significantly reduce your overall returns. Canadian investors in particular face some of the highest mutual fund fees globally. This can make a big difference in your overall returns. It's important to be aware of these fees and how they affect your investments. Make sure you understand the fee structure, compare options, and consider lower-cost alternatives like ETFs. ETFs often have lower fees compared to mutual funds. This can save you a lot of money in the long run. So, start early, stay disciplined, and keep an eye on those fees. These simple steps can make a big difference in your investment success. By following these guidelines, you can avoid common mistakes and improve your financial future. Avoiding these common mistakes can put you on the path to financial success. Happy investing. Remember, the key to successful investing is to start early, stay disciplined, and be mindful of fees. With these principles in mind, you can achieve your financial goals and secure your future. If you found this video helpful, please like, comment, and subscribe to our channel. And don't forget to check out our recommended videos for more tips on investing and financial success. Happy investing!